What would another rescue mean for Europe's debt crisis? To talk about this, I'm joined by Barclays Capital's chief European economist, Julian Callow. Hi, Julian. Let's start with the bill sale a little bit later this morning. Will it go off without a hitch? I mean, they'll pay higher for it, won't they?
Well, it's very short-dated debt, so I guess it will do. Obviously, the concerns are very much that you still have a lot of redemptions this month, but you also have very heavy redemptions coming through in June, which is, of course, the date of the election, and the yields speak for themselves, really. And we've got reports in the newspapers this morning talking about reluctance on the part of Portuguese banks to be increasing their exposure significantly further. So one way or another, we are moving into the end game of a bailout here for Portugal.
The question is one way or another. What way? Because it's tricky, isn't it? Because you don't have a permanent government.
Yeah.
Will there be some sort of bridge loan, as has been suggested? Would that work?
Well, that seems to be the only option, really, I guess. But in that context, it's still going to be quite difficult to achieve it. I'm not sure that you necessarily have the mechanisms in Europe itself. Now, the IMF has its flexible credit lines, but the question is, would the IMF be willing to supply one of those in the case of Portugal, where it is right now? You can't assume that you can automatically draw on those. So the situation is very, very messy, and for sure it would be far better if we could have a much more organised solution here. As usual, the big problem in Europe is that matters really have to come to a big head before you actually start to see some actual package being implemented. Things never go easy in this front.
And it comes as the ECB, of course, prepares to announce their rate decision tomorrow.
Yes.
You're a member of the shadow ECB.
Yes.
Can you tell us how you voted?
Oh, yeah. Well, I voted for unchanged still. I'm a little bit cautious here. In fact, that was the majority view of the shadow ECB Council. At the same time, I can see a case at some stage later on you may need to raise rates.
But they will raise rates tomorrow, won't they?
It's extremely likely that they'll do that. The interesting question is in a way what they will do about the interest rate corridor, and of course what they will communicate around the interest rate corridor.
What do you think?
There, I think it will be widened back to plus or minus 100 basis points.
Yeah.
So that would mean leaving the deposit rate steady at 0.25%, but increasing the marginal lending rate by 50 basis points. That would have the effect of encouraging the banks to intermediate more in the money market. So it would be a return, a little bit more progressive return to normalisation, and that would be a signal, I think, that the governing council.
And what about guidance? How will Trichet guide the markets on his future rate intentions?
I mean, you know, normally when we're at the start of an interest rate tightening cycle, the ECB is very reluctant really to commit to much more and just to present the first increase as a one-off. But there again, we are dealing with very low rates, and you have to ask yourself, well, if the ECB is starting to tighten rates at all at this particular stage, then presumably it is going to be a series of steps. It's not just going to be a one-off. So it's going to be quite a tricky communication exercise for Trichet. He's also got to keep an eye on the Fed and an eye on what the currency rate is doing here, and there is a lot of uncertainty around, but it's going to be hard for him to rule out at least some further tightening later on this year, I think, in the communication.
And you talked earlier about how Portuguese banks are becoming reluctant to buy more Portuguese debt. What would an interest rate hike mean for peripheral banks? It's going to increase the burden on them, isn't it?
Well, that's right, and particularly, I think, for households and businesses in the periphery. I mean, if we're looking at countries like Spain or Portugal, we're talking about household debt ratios that are 80% or 90% of GDP. You can imagine that, of course, the debt is only held by a proportion of households, not by all households, and the debt is linked to Euribor interest rates, variable interest rates, almost entirely. So if you have an increase, it is a very big negative impact for the debtors. Their debt servicing costs are going to be increasing, particularly if it's not just one increase, but the market expects it as a series, and already Euribor rates are reflecting that, I think, and that will certainly eat in further to disposable disposable income. And, you know, yesterday's retail sales numbers were very interesting, I thought, for the euro area. The French series has still been going up, although it's starting to slow down a bit. The German series is increasing very, very slightly, almost imperceptibly. But the Spanish and the Greek and the Irish and the Portuguese retail sales volumes are all actually still falling very, very sharply, which is really reflecting the concerns that exist around these countries.
Julian, stay there. We're going to come back to you in a second. A few members of the FOMC, Julian, say tighter credit may be warranted. Is the centre of gravity just shifting slightly? Slightly.
Yes, I mean, clearly that is, and that's only to be expected given the numbers that we're getting out really on the inflation side. Of course, the Fed looks through the headline inflation numbers. What it's concerned about is the transmission through into core inflation, and particularly medium and longer term inflation expectations. And I think the Fed Chairman Bernanke made this very plain a couple of days ago. It's the medium to longer term inflation expectations that really matter here for the Fed. And those, according to the FOMC minutes, the Fed is still viewing as relatively stable. But if those do start to rise here, then the Fed would have a major challenge on its hands, and it would be changing course. As it is, the Fed has this confidence that when you have a big energy price shock, there is also a negative impact on demand, as well as the short-term positive impact that comes through on inflation. And that was also, I think, very clear from yesterday's minutes. So all in all, the Fed still seems very likely to run with the full duration of the asset purchase program, concluding it at the end of June. That's 80 billion euros of US, $80 billion of US purchases per month. And then probably a lengthy period where interest rates are still held down at very low levels.
What's the significance of the fact that it seems as if the ECB will be raising rates ahead of the Federal Reserve?
Yeah, I think there it is very significant. I can't really recall a time where we've had such a dislocation in the monetary policy tightening cycles. We have maybe seen back in German reunification in 1990, some differences in stance, but that is the only historic example. So it's a very big issue when we have the Europeans starting to tighten policy here. The euro is reflecting that. I think the euro probably does have some scope to push higher in the near term, but then I think once the Fed stops buying assets, and that will come in the second half of the year, then I think we will be set with the conditions for the dollar to start recovering some ground here against the euro, because the euro is actually getting quite overvalued here against the dollar.
We're about 142, so how high might it go in the near term before it starts to come back?
I mean, certainly 145 looks possible. I mean, I think I'd be surprised if we really went up to 150 at this stage, because already you're starting to see the new orders in the PMI numbers for the euro area start to weaken a little bit. By the way, you're also seeing the export new orders numbers from the US ISM survey actually be quite strong. So I think things are starting to reflect the exchange rates here. Yeah.
Julian, thanks for joining us
Mark.
today. Julian Callow there from Barclays Capital.